Welcome to today's video. In today's video, we'll get a fair understanding of what's happening in the dollar rupee and what should importers and exporters do. So the dollar rupee pair continues to trade with a strong upward bias as the pair moves in the upper end of the rising linear regression channel, which is visible by the parallel blue lines upward sloping. Now, despite a softer global dollar index, rupee remains one of the weakest Asian currencies, that is driven by persistent dollar demand, geopolitical concerns and limited RBI intervention. Even if we take a look at the onshore chart, dollar rupee is very firmly holding above its key moving averages. Now the 50-day moving average comes closer to the 88.57 levels, whereas the 100-day simple moving average comes close to 87.96 levels. Now the price action remains in the upper half of this bullish channel, indicating sustained momentum and consistent buying on every dip. And the onshore chart also shares very similar traits, and we see a very clear pattern of higher highs and higher lows since the month of June. Multiple candles we have seen with long lower shadows, highlighting how quickly these declines are absorbed. While recent strong closes near the daily highs do certainly signal that the demand for dollars are at very elevated levels. Our trade deficit also supports this, as we see record-breaking trade deficits every month. Now, as the spot approaches the upper resistance of this channel, we can expect a short-term consolidation or even a minor pullback. But as long as dollar rupee stays above the support cluster around 88, the medium-term trend remains firmly positive. For dollar exporters, this is a very favorable zone for hedging. A mix of forwards with higher allocation and vanilla options with lower allocation will provide good protection while offering flexibility if the pair does correct. Staying unhedged at these levels should be considered very risky when we have seen that the pair has a potential for sharp correction of 40 to 60 paisa on an intraday basis. We've seen this happening in the recent past as well. Now for dollar importers, they should stay patient. They should look to hedge in case of any dips, especially towards near the support levels. Locking forward rates near the upper end channel of the resistance is not a very good idea, unless of course you're mandated by company's risk management policy. If hedging is essential, do choose vanilla options over forwards, as they do cap the risk while allowing you the participation if rupee gains. Now, all things considered, dollar rupee remains structurally very strong in a bullish trend. Exporters should certainly act, while importers should wait or hedge selectively. Thank you for watching.